Hello, everyone. It's great to be here with you. Today, I'm going to tell you a little more about a new thing, which is cross-rollup MEV. I am a researcher at Matter Labs and also a PhD candidate at University of Zurich. And generally my PhD research is about security and scalability of DeFi. And simply layer 2s and MEV is where those areas intersect with each other. I hope that today I also give you some background information why actually people are doing MEV, what you can extract and where, and yeah, highlight those new places like L2s where you can look for that. Such those layer 2s and the rollups are becoming more and more important. You can see that the whole decentralized finance was born on the Ethereum blockchain in 2018, with Uniswap being the first exchange. But you can see that over time, mostly because of the high gas fees, the trading volume is moving away from Ethereum to another blockchains. And it's not only Solana where the trading volume is moving. You can see on this chart that a very big part of the trading volume is moving away from Ethereum to those layer 2 blockchains that are based on the Ethereum. Also, the Ethereum is currently having a rollup-centric roadmap, and is being encouraged by the Ethereum itself to move the user activity to rollups. When you look at the numbers, there are actually already more swaps, more swap transactions happening at rollups such as Arbitrum or Base than on the Ethereum mainnet. It's just they are still smaller in volumes. But maybe a very brief repetition about what is arbitrage, because the more decentralized exchanges we having, the more L2s we are having. It means there are more trading venues, and the arbitrage is simply a situation where you can buy some cryptocurrency at one exchange for a lower price and sell it at another trading venue for a higher price. And you can see here example where you can buy something at AMM like one ETH for $2,300 and sell it at Binance for $2,400. And this is simply arbitrage because it's almost risk-free reward. And simply what we are asking ourselves in our research paper is, are there price differences between the decentralized exchanges that are located on Ethereum and on the layer 2s and also Binance? Because in theory, if the market is efficient, the prices everywhere should be equal. This is question number one. Question number two is, if there are those differences, how big they are, and can they lead to the arbitrage opportunities? So are those differences in prices big enough to cover the bridging costs, to cover the transaction costs, and other related costs? And then the third thing is actually the most interesting, is how to explore those opportunities. So how can we make sure that actually we will be the ones that are exploiting that arbitrage MEV? And now maybe how MEV is working on Ethereum. There are generally three types of MEV. It's back running, front running, or the combination of the above. And the biggest part of the MEV on Ethereum is actually back running, which is when there is a target transaction and the MEV searcher wants to put his transaction just after the target transaction. And typically, the target transaction is a transaction that is, for example, causing a big swap on the exchange, causing a big price differences between a DEX and another DEX or SEX. And then, we simply want that our transaction will be as close as possible, ideally just after that swap transaction that caused that pricing imbalance. Another application of that MEV backrunning is in the DeFi lending. It's about liquidation, when you want to liquidate the bad debt as soon as possible. It's also linked to the Oracle extractable value. And actually, when you look at the numbers, like over 70% of the MEV on Ethereum mainnet is related to the arbitrage. So it's simply looking for that price differences between different trading venues. And also from that arbitrage MEV, over 60% is actually related to the CeFi DeFi arbitrage. So when you are simply trying to exploit the price differences between the DEXs on Ethereum and the Binance, Kraken, and other centralized exchanges, and only 30% is actually related to the cyclic arbitrage within the same network. And then the question is it the same or will it be the same on the rollups? So actually, just to make sure that everybody knows what the layer 2 and the rollup is. I mean, I will be using those words interchangeably, although they are not the same, but they are almost the same. Like simply a rollup and the layer 2 is a scaling solution where you take complex calculations outside of the Ethereum, you do those calculations, and then you store back the results. There are different types of the rollups: optimistic, zero knowledge, and they typically have the one major component, which is called the sequencer, which is actually super important for the layer 2 blockchain, because it's the sequencer who is producing the blocks and deciding on the order of a transaction within the block. I mean, today, almost all of the rollups and all of the major rollups are running only one sequencer. That's why there's the problem of a centralized sequencer with the rollups. And generally, we are trusting those centralized sequencers because they are operated by the foundations that are simply standing behind those rollups. And what's actually important, as a consequence, we don't have those MEV auctions like flashbot style solutions on layer 2s. I mean, typically, when you think about layer 2s, you think about two things. So first of all, is the Ethereum security and lower gas fees. But those two other components, they are also very important when you look at the decentralized finance on L2s. Because as I mentioned to you, there are no MEV auctions, boost auctions yet. And also the block production is much faster. I mean, on Ethereum, it takes between 10 12 seconds to produce a block, whereas on the rollup, I mean, depending on the implementation, it's around 1-2 seconds or sometimes even 200 milliseconds. And this is significantly changing the MEV strategies on L2s. And simply, now let's look at the results that we achieved. You can see on this matrix behind me the price comparison between Uniswap V3 pools of ETH and USDC. We simply compare the prices for the first half of this year per block frequency between the deployment of Uniswap across Ethereum and its five major rollups. And you can see that actually there are some differences. There are like, I mean, one of the biggest differences are on the ZK Sync, followed by the big differences with base. And then the natural question then that you can ask is, are those price differences big enough to cover the costs of extracting them? And also, once you see that there is a price difference between the Uniswap, for example, on ZK Sync and Uniswap on Arbitrum, how big the transaction should be. So actually, what you can do, you can calculate the optimal size of optimal volume of a transaction that is exploiting those price disparities. I mean, depending on the AMM type, the formula is simpler or more complex. For the Uniswap V2, it's actually quite simple. Here you can see the transaction volume, which is equaling the size of the transaction volume, which is equaling the price differences between the DEX and SEX. And here you can see actually how much money the arbitrageurs is making. And here you can see that actually it's increasing. The bigger the transaction is, but there's always like one point when it's the optimal and it's the highest value. It's also related to the fact that typically those AMM functions are concave. And here, depending on the complexity of that AMM function, you can simply calculate and find those points. And this is simply what we did in our what we are doing in our research. And in the first part of that research, we actually compared the prices between the Sync swap, which is the largest AMM fork of the Uniswap v2 on the ZK Sync, with the prices on Binance. You can see here above the biggest daily price difference. And here you can see in the blue actually how much the arbitrageurs was actually making each day. And I mean, it's rather intuitive that the bigger the price difference, also the higher was the revenue of the arbitrageurs. However, you can see that here is the size of the liquidity pool of the reserves inside the AMM. And it's playing an important role because you can see that actually even on the days when the price differences were bigger, but the liquidity pool was lower, like in that case, arbitrageurs were making less money than here on that point, where simply the smaller price difference led to the higher revenues of the arbitrageurs. So it's very important to look, when you're trying to estimate the profit of the arbitrageurs, to look not only on the price difference, but also how big those liquidity pools are there. And in the next step, we simply make that formula more generalized, also applicable for Uniswap v3, and we simply start to compare how much you can extract in profit between different rollups. And you can see here because, for example, the pools on the Uniswap at ZK Sync are not too big at that point, like the profits were rather low compared to the other Uniswap deployments. And here the highest revenue of the arbitrageurs are here in this area. So between Ethereum and the different deployments on Arbitrum. And you can see that actually the cross rollup arbitrage can be even higher between the rollups than between a Binance and another rollups. Here actually the highest arbitrage, we calculated we found between the Binance and Ethereum, but quite often between the rollups, cross rollups is actually higher than between a rollup and a Binance, which is most of arbitrageurs are doing today. But then the next question, actually you can ask yourself, okay, once we know how big is that, we know the price difference, we know how big the profit of the arbitrageur can be, then how can we assure that we will win that profit, that nobody will front run us? I mean, on Ethereum it's possible. On Ethereum it's possible, on the rollups it's not possible. Maybe another important thing is, I forgot to mention, is that you can look here, that those price differences, they last quite long. We simply calculated how much time does it take between the prices at those Uniswap deployments and the Binance, they become equal with each other. On Ethereum, it's like 31 seconds. On Arbitrum, 7 seconds, and other chains more. But here, you also need to remember, when you look at those seconds, that there is a different block production. Because, I mean, 30 seconds on Ethereum, it's maybe 2.5 blocks. Whereas on Arbitrum, I mean, 7 seconds means almost 30 blocks. Because the block production is much faster. And this has a big impact on the extraction of that arbitrage MEV, because typically even not typically, if not always, on the L2, when you have a target transaction that is causing some big price differences and you're trying to exploit it, your transaction, your MEV transaction will be in the second block after it. So it's almost impossible unless, you apply some certain strategies to be within the same block. It's also related to the fact that the blocks are produced much faster. And then there are two options that you can apply to look for to exploit the MEV on L2s. One is when there are DEXs within the same blockchain, like in that case. There are like two DEXs, for example, on optimism, and you can equal the price between them, or you can look for like a triangular arbitrage, like between the three different tokens and the pools, and then try to equal those prices in one atomic transaction. And the people are already doing it. You can see how much of such atomic arbitrage was already exploited. But I mean, remember that actually on Ethereum, that type of the arbitrage, atomic arbitrage between DEXs corresponds only to 30–40% of the total arbitrage, meaning that if we are compare it to the Ethereum, still 70% of MEV is not captured here. And here, when it comes to the looking for non-atomic arbitrage on the L2s, which can be between the L2 and the rollup, or between two rollups, there are three different possibilities. So one is, but I mean, most of the rollups don't support that. Yeah, you can take part, you can simply pay a higher gas fees to increase the chances that your transaction will be executed faster. But what actually a lot of people are doing, they are looking for the sequencers that are running the rollups, and they are simply trying to be as close as possible to that sequencer. So this is the old school approach known from the traditional finance and high frequency trading. And another thing that you can try to do, you can simply spam the network with your transactions, because the gas fees are actually super cheap on the rollups. And I mean, all those things are actually already happening. Especially that in March this year, the Ethereum underwent a very big upgrade. It was called Dekun upgrade. Happened here on the 13th of March. It introduced the blobs, and as a result, gas fees on the rollups went down almost to 1 cent and below, which is making doing any transactions on the rollups super cheap. And because it's so cheap to do transactions on the rollups, you can simply take a risk of doing that non-atomic arbitrage transactions. Because even if your transaction is not successful, you run it too late, I mean, you will lose, I mean, it can be reverted, you need to pay a gas fee, but the gas fee is so low that you don't risk much. And you can see that actually the amount of the reverted transactions after that Dekun upgrade increased hugely after that Dekun upgrade. And then, actually, I already mentioned that when you are the arbitrager trying to execute that arbitrage MEV between two rollups, your biggest risk is that is called the price or state drift, meaning that you buy, for example, an asset on one rollup, but you don't manage to sell it on another rollup before the price changes. And there are different approaches how it can be mitigated. One of them, which is actively being researched, I think also by Flashbots, is about introducing time boost auctions inside the sequencers of rollups, where you'll be simply paying more for getting like a super speed for your transaction. I mean, as you are anyway paying maybe to a DeFi solver for getting close to the, getting physically close to the sequencer, why not, instead of doing that, simply take part in that boost auction. Another approach is actually using a so-called shared sequencing, which is under a heavy development within the L2 community. And such shared sequencer is quite important because, let's say in the final stages of its implementation, it can allow for two things. Like one thing is can make simply the transactions across two rollups atomic. So simply that non-atomic arbitrage can become atomic arbitrage, eliminating the risk for the arbitrageurs. And also the second thing that such a shared sequencing can bring is the shared liquidity, meaning that you'll be able to reuse pools on different rollups or move your reuse on one rollup tokens from another one. This is actually something that we are actively researching at Matter Labs. Also, my colleagues are here who are really studying it. If you are interested, have a chat with us. And then, that was my talk. If you have any questions, feel free to ask. Thank you.
Yeah, Chris, good to see you again. Just wanted to ask you a question. How much of L2 arbitrage is open because your sort of traditional arbitrageurs on L1 just don't want to keep liquidity on the chain? So is it really an atomicity problem, or is it an inventory problem for L2 arbitrage?
And that's actually excellent question. So here maybe I just underlined one fact that in those studies, we simply estimated arbitrage that can be exploited. So it's not the arbitrage that people are already exploiting. This is simply what's there and how much time is there. So the question is, why is it so long and why people are not doing it faster? There are two things. One initial concern was there were not too many well-known AMMs running on the rollups like Uniswap or Curve. Yeah, they are just entering that area. And the second thing is the liquidity. It's still limited at some rollups. So even if the price differences are big, they maybe represent 20 bips of a trading volume. It's still for a big arbitrages running, $1 million companies. It's a small cake. But it's growing. So the trading volume is going up. So I expect that we see those opportunities disappearing faster.
I guess the question is why is ZK Sync seems to be always lagging or have the greatest price difference? Is this a function of liquidity on the chain?
Yes. Yes, but there are also some deeper reasons behind that. So simply those rollups you can see here, they are optimistic rollups, whereas ZK Sync, it's the zero knowledge rollups. And simply optimistic rollups, they manage to have more liquidity because for them achieving EVM compatibility is easier. Whereas for the ZK rollups that you want to be EVM compatible, it's more difficult to develop EVM, and that simply resulted to the fact that those DeFi protocols came there later. But what you will get from the ZK rollups versus optimistic is a faster finality, especially when the sequencers become decentralized. So there are always some trade-offs.